So thank you very much. That was a good first session. So the next session we're going to do is talking about tax workshops. Predominantly we're going to talk about business structures and benefits of business structures, and also we'll dabble a little bit in the tax space. So Michael has an idea for a business. Sorry, Michelle. It started out as Michael, then I had to go and change all the pronouns. Michelle has an idea for a business. She knows that she wants to make $85,000 in profit to replace her current annual income. I did some analysis and it turns out that $1,666 is the average weekly earnings, and then if you extrapolate that, it turns out to be about $87,000. In the 12 months to November of 2018, full-time adult average weekly ordinary time earnings increased by 2.4% to $1,604.90. The full-time adult average wage total earnings in November 2018 was $1,666.20, which is a rise of 2.2% for the same time last year. So $85,000 is not a bad earning income from a business. So the question I had was, what sort of business structure would we set up if we wanted to make an $85,000 profit and maximise our taxes? So what structure should she use? What does she need to know? And what are the pitfalls of getting into business? Okay.
So don't do it.
So apart from a couple of people saying don't do it, let's have a look, okay?
Stay where you are.
Stay where you are. So when it comes to setting up a business, entrepreneurs can choose from many structures. Choosing the right business structure can be a complicated task. The first step is to ascertain the best structure for your needs. Okay? So as you can see, there's broadly broken up into sole traders, partnership, company and trusts. So some advantages and disadvantages of sole traders. In terms of advantages, they get to retain 100% of the profit. You, as a sole trader, are your own boss. You don't have anyone telling you what to do, which is probably the reason why you got out of being an employee and into your own business, because you were a middle-aged man that was sick and tired of dealing with the people in your chain of command. There wasn't the same business, there wasn't the same work that you joined back in '86, so you said, enough. Startup costs are relatively low. If you want to buy a McDonald's, not so low. Easier decision-making process, because you're the only person that has to make a decision. There's no, we don't have to have a meeting, we don't have to have a round table, we don't have to have a confab. And you can easily wind the business up. Now, today, going to shut up shop, close the business, that's it. So some disadvantages are unlimited liability. So liability is around the ability to be sued and possibly lose all of your assets, as well as bankruptcy, insolvency, etc. So unlimited liability, things like personal assets may be exposed and or seized to repay a debt. There's little opportunity for effective tax planning. So if you've got a business and it's making $250,000 profit, then as a sole trader, you're going to pay somewhere around $105,000 in tax. There's no effectiveness in doing that, and if you were a client to come to us and said, I've got this great business and it's making me lots of money and I've been a sole trader for a number of years and I'm paying all that tax, and I'm going to say, well, bloody more for you. Pay all the tax on the income earned in the business. As I just said, $250,000, somewhere probably, 105 is probably very conservative, probably more like 145. There's a limited life of the business, so when you die or you get sick, business is finished. There's no continuation, there's no continuity, there's no planning. And of course, taking holidays can be an issue. So if you're the only person operating in the business and you want to take a holiday or you get sick, then there's a few problems with that. So partnerships are generally 2 or more, but they're also capped at 20. You can't have a partnership with more than 20 individual partners. So again, startup costs are low. Perhaps 2 or more heads are better. Tasks and duties can be split along specialisation lines. Perhaps someone's strong in the marketing or sales area, someone else is strong in back of house or HR or wherever the case may be. Access additional capital. So instead of just coming to the party with all of your money, you can also get your partner to bring some money. So perhaps it's a 50-50 capital injection, perhaps it's a capital share buy, but also a loan. Maybe they've got some good collateral and they can lend the business some money and repay the loan. Disadvantages, it's generally capped at 20 partners. Again, it has unlimited liability. And each partner is liable for the debts incurred by the actions of other partners. So if one partner decides that they like the size of the bank account and they want that money and they skive off with it and they leave you with a whole bunch of debts not paid or employees not paid, then even though it's a partnership, you're just as liable to get that money, to have to pay that money, even if they've done the wrong thing by you. There are two types of companies, private company and a public company. A private company is generally limited to up to 50 employees as shareholders, and then obviously a public company is a minimum of 5 shareholders, and the number of shareholders is infinity depending on the number of shares issued through a prospectus. So a private company has limited liability. They are an entity into themselves, so they have perpetuity, they go on indefinitely, they don't have a shelf life, they don't have a life like a trust of say 85 years, they're not like a sole trader and relying on an independent worker, they're not like a partnership, again locked into life of a partner. Shareholders and directors can be employed and pay their tax marginally. So we talked earlier about STP, so you can pay yourself as a director, as in employee's wage, you pay your PAYG, you pay your superannuation, and then you get to the end of the year and you might still get a bonus from the profits left at the end, even though you've just paid all of these expenses. Up to 50 non-employee shareholders, and effectively a company has the powers of an individual, and they can own and dispose of property and assets, enter into contracts, and importantly sue and be sued. So when ABC Proprietary Limited messes up, you're not suing Erica or Steve or Michael or Cameron, you're suing ABC Proprietary Limited. And then when you find out that they've got no money, then you probably wouldn't start litigation anyway. Disadvantages of a private company. Higher cost of formation. Cost about, at least $600 to pay ASIC, plus other consultants' fees to get the business started, ABN registration, tax file registration. They have a higher rate of tax. The company rate of tax at the moment is 30%, and it's going to come down to 25%. The compliance requirements, $260 or something just to do an ASIC return, an annual return, and higher cost of compliance. So there's the tax return, the ASIC return, as well as every other return. Shareholders, financial statements, etc. Family trusts. Some advantages to family trust are they can protect your personal assets and business assets. So an asset inside the trust belongs to the trust. It doesn't belong to Cameron or Deb or anyone else. That belongs to the trust. So if you two should go separate ways, you can't sue the trust because he doesn't own the house in the trust, doesn't own the car in the trust, he doesn't own the business in the trust. He's got nothing. It's a great a superb tax planning tool. You can take advantage of powerful wealth creation vehicles. So we talked earlier about a sole trader with $250,000 in tax. It's nothing better than having a trust where you can disperse money to beneficiaries that have a lower tax income and therefore pay less tax than you would. It also enhances personal financial planning, minimises tax obligations and better plan for future generations, keeps assets in the family lineage, so if the housewife of St Kilda should happen to come in the family and she decides that she wants to fleece someone, there's nothing to fleece because he doesn't own anything. And it also helps mitigate family disputes. Again, same thing. You can't have a divorce if there's no assets because there's nothing to divide. Disadvantages, Trustee may use discretion to change allocations to beneficiaries. So if you're a beneficiary, just because you got an allocation last year from the trustee, doesn't mean you're guaranteed of getting one this year. There are regulatory burdens and there's also taxation burdens. So to have Michelle's business get up, she's got to have an ABN. It's a unique 11-digit number which identifies the business to the tax community as well as to the public at large. It's in consultation, or it's in. It doesn't replace the tax file number. It's used in conjunction with a tax file number, except an ABN is just about operating a business. So obviously, a business is defined to be an ongoing entity with a view to making a profit, basically along those lines. So hobbies aren't businesses. Hobbies don't need tax file numbers. Dance students are operating a hobby. They don't need an ABN. ABN obligation. And I spoke about this earlier. Basically what they're going to do is, at the moment, you have to lodge your tax returns to keep a valid ABN. If you don't lodge your tax returns, then they'll just cancel your ABN. And therefore anyone that's doing due diligence and looks up an ABN and finds it's been cancelled should withhold 49% from the payment. That's an obligation under the Tax Act. And from the 1st of July 2022, there's a requirement to go in and do an annual review of your ABN details. So what I've done is I've got the trustee for our class accountants. It's been active since the 22nd of 2018. It's a fixed unit trust. Currently we're not registered for tax, and there's our two business names down here. So that's what if you went and looked your ABN up, you would find a very similar image, I guess. I know we said no questions. What's the threshold for GST registration? $75,000, that's right. So goods and services tax, which came in about 1999, 2000, they introduced it under the Howard government. It's been set at 10% across most goods and services, and everyone, even as recently as last night when we were talking about the budget, talked about changing to become a broader base. You know, get rid of some of our GST-free items, and if you operate a business, then everyone's got to be registered for GST. So it's a 10% tax that's levied on goods, services and other items sold and consumed in Australia. So that includes your Facebooks, that includes your Google ads, that includes your Microsofts. So all of these foreign entities still have to charge you GST, and then if you exchange your ABN with them, they will not charge you GST because they don't collect and they don't have to pay. So that's a little bit easier for them. GST applies to most Australian businesses, and it is highly likely that your business will be affected by tax. So if it's over $80,000, over $75,000, then you must be registered. If your business is registered for GST, you'll have to collect some extra money, 1/11 of the sale price from your customers, and pay it to the ATO when it's due. Do I need to register for GST? You must register for GST if your business has a GST turnover of $75,000 or more, if you're a not-for-profit organisation and has a turnover of $150,000 per year or more, or you provide taxi, read that Uber, read that any vehicle carrying service, in exchange for a fare as part of your business, regardless of your GST turnover. So at the moment, Ubers and taxis are registered at $1. So as soon as they turn over $1, they've got to be GST registered. This rule applies to both taxi owners and people who just rent a taxi. So when they say rent a taxi, they're not talking about when you get into the taxi, but if you have someone buys a licence and you want to run that car against that licence, then you pay someone for the privilege of using it. So in terms of tax compliance, if you've got GST, then you'll end up having to do a business activity statement. If your turnover is high enough, it could be every month. If your turnover is less than $2 million, I think it is, it's every quarter. And some people only register for an annual return if they've got a very low tax turnover. Income activity statements, we spoke about income activity statements. Basically they're for businesses that the government wants to be able to assess what your income's going to be for the year. So what they do is they look at last year's income tax and then they levy that over the 4 periods of the following year. Some people are on monthly income activity statements because their payroll is higher, but most are only on quarterly income activity statements. So tax returns also are part of the tax compliance. They affect individuals, partnerships, companies and trusts. And there's one other report called a TPAR, which at the moment affects the building industry, cleaners and security. And from the 1st of July this year, it's going to affect people in the IT business as well as a couple of other people. So if you've got any questions about TPAR, give me a hoy and we can go through it. But basically, it's the tax office's way of matching what's being paid and what's being received. So if there's an anomaly, for example, between what company A pays sole trader B, they can sort of sit down and say, okay, well, where's the timing difference? And the government doesn't like to be robbed from themselves. So in terms of a tax on $85,000, I just did some quick analysis. So we've got sole traders, partnerships, company and trust. So EBIT is earnings before income tax. So everyone gets to earn $85,000. So in terms of a sole trader, they've got $85,000 and the assumption is there's one sole trader, so they have to work out how they're going to manage their tax affairs based on that $85,000. In terms of a partnership, what we've got is we've got 2 partners sharing equally of the $85,000 profit, so they only get assessed on $42,500. In terms of a company, it doesn't matter how many shareholders there are, company pays 30 cents in the dollar tax on $85,000. And in terms of a trust, again, it doesn't matter how many beneficiaries there are, there's $85,000 available for distribution to all the beneficiaries. So in terms of tax payable, I've got some assumptions which I've made. So based on a sole trader, on this amount of money you would pay this much tax. Does not include 2% Medicare, because along the lines I wanted to show that if you added 2% of that, which is $1,900, to that, then you would end up with less tax here, which would then have an effect on these as well. So it's assumed that there's no Medicare levy here and no Medicare levy here. So as you can see, as a sole trader, you pay $19,172 in tax. Your after tax is $65,828. That's your average tax rate, which is this amount of money over this amount of money of 23.94%, 93%. But your marginal rate is 34.5%. So that's where you fall into the tax tables. In terms of a partnership, we've got the same amount of money, but we've been able to split it between 2 people. That means each person has got their share of $18,200 tax-free. So then you get taxed on what's left. So each couple gets taxed $5,359. When you group that up, that becomes $10,718, or they're at least $9,000 better off than they would be if they traded as sole traders. So after tax, they get $74,000, or again, about $9,400. Their tax rate is 12.6%, which is considerably less than the sole trader. And again, they're in the marginal tax rate of 32.5%. A company has $85,000, it gets taxed at 30 cents in the dollar, or $25,500. You take that tax away from that and you're left $59,500 for distributions to shareholders. The thing about a company is once you distribute that to each of the shareholders, and again, let's say there's 2 shareholders, what would happen is that would be called a franked dividend. So that then comes back to here. It then gets grossed back up to $85,000 because they take the tax that you would have paid, add that back in, and then they apply the tax rules. So if you have a company and it's between 2 shareholders, you could still end up with a tax burden like this. In terms of a trust, we've got $85,000 is available for beneficiaries. There are 5 people in this trust. three adults and 2 children under the age of 18. The children under 18 can get as much beneficiary as you want to give them. However, they pay huge amounts of tax, up to 49 cents in the dollar tax, over $416. So the assumption I've made is we've got 2 children under the age of 18 and they're going to get $416 tax-free. The other 3 adults are 2 adults, mum and dad, and a 20-year-old son, I think it was. Anyone over the age of 18, basically, as a student or working. So their total tax burden is $5,618. So being able to split it across 5 people in a trust is vastly different than an individual, a partnership or a company. But the benefit is, so of the 85, you take home something like $79,000 or a 6.6% tax burden. Okay? So this is, I guess what I wanted to talk about was there are a few caveats, a few things I talked about. You know, it depends on the age of your dependencies as to how much tax you're going to pay. If you've got low income earners, then you want people to be able to take advantage of the $18,200 tax-free threshold. So your distribution to your mum or dad might only be $18,200. Don't pay any tax. So there's a saving there. You can pay $36,000 to your parents and not have to pay any tax at all. The thing about minors is what they're trying to avoid is they're trying to avoid minors getting, you know, $18,000 and not paying any tax. So they call it unearned income. It's the same as if you put that money into a bank account and they earn huge money in a bank account, they would be taxed in the same way as if they were beneficiaries of a trust. It just, yeah, it's ridiculous how much it is. But that's, so, and the final thing is just basically a graph that just shows sole trader, partnerships, company, and trust. So there are some benefits in having a partnership, mainly because you've got 2 operators and you can share the love and share the profit. And obviously, if it was right, we would probably recommend a trust. But just because it looks good here, in this scenario, does not mean it one size fits all. So it definitely takes you sitting down with your tax advisor, going through and sort of saying, okay, well, what can we expect to make? And what do we have to expect to pay in tax? And again, all I picked 85,000 because that was based on the average weekly earnings. So I had to start somewhere. We could have picked a big number or a small number and got a different result. So has anyone got any questions on that? No. Oh, sorry, here we go. Michelle gets $30,000 and pays $2,242 in tax. Paul gets $30,000 and pays $2,242 in tax. Ian, their 20-year-old son, gets $24,168 and pays $1,134 in tax. And Sean and Leanne, their 2 minor children, get $416 each, no tax. So that's just the underlining. So what should Michelle do? Well, I think Michelle should engage with a trusted financial advisor with her draft business and marketing plan. Then I think she should go with a family trust. That's my advice. She should obtain a tax file number and ABN for the trust. Now, with a trust, there is normally 2 types of trustees. There is a corporate trustee, which is a company, or a non-corporate trustee, which is an individual, or you could have a body of trustees. But a trustee is just someone that manages the trust because the trust can't manage itself. It's the same as a company has directors, shareholders own the business, beneficiaries own the trust, but directors are the mind and body of the business, of the company. Trustees are the mind and body of the trust. They give direction. Can a trustee be a beneficiary? Yes. Generally, you'll find the settlor is not the same person as a beneficiary because there's a bit of a conflict there. But so you have a family trust and you would normally probably go with a company as a trustee, again, because if something goes wrong with a trust, they're going to hold the trustee personally liable. And we all know that an individual has unlimited liability. Corporations have limited liability. So you obtain a tax file number, obtain a trust, Register for GST if it's appropriate. If you're going to make $85,000 profit, then you're already above the $75,000 threshold, so yes, you'll have to register for GST. Register the business name, Business Done For You. Should have a little T next to that, shouldn't it, like trademarked. Obtain a website and build her business in accordance with the plans. Thank you. If you've got any questions, I have business cards and flyers. Contact me. And one of the events coming up is the dissection of the budget. I'm not sure what date that is, but stay tuned to the website. Thank you.